Hello everyone, and thank you for watching my videos. So far we spent a great deal of time talking about technical analysis. We learned about the tools on our trading platforms, we learned how to read charts, look for patterns, and also how to read lines of support and resistance. However, we cannot ignore the other two types of analysis, such as fundamental and sentiment analysis. And we covered a little bit about sentiment analysis in some of the previous videos, but what I want to do now is focus squarely on fundamental analysis. We can't ignore that because fundamental analysis works like this. It is fundamental analysis, it tells us where the market is going to move and how the market is going to move based on information that we get from news sources. So whatever information we get from governments, central banks, or just any form of economic data can affect what happens with the currency pairs that we're investing in. So let's take a moment to discuss fundamental data and how it works. So fundamental data, it comes in many different forms. Now, on your trading platforms, you should have an option that tells you the different news stories. You click on that option and you have different news stories, and you also have an option to view releases about certain types of information such as Tokyo machine orders or the interest rates on the European Central Bank or new homes being built in the United States. And also with that information, you also have predictions as to how many homes will be built in the United States, and or how many new jobs have been created in the UK. So all of that is included in fundamental data. And there's also information based on what the Department of Treasury is planning to do and what central banks are planning to do. So there's so much information that we need to get from the news, and we need to have that available to us as we're looking at the charts. So we have to be able to understand how fundamental analysis affects this market. Now, let's talk for a moment about economic data. So economic data works like this. The market reacts based on how people feel about the market. Obviously, if the people of a country are satisfied with their government and satisfied with their economy, then they will have a positive attitude. That positive attitude can be manifested by spending more and investing more. So we want to pay attention to those numbers. How much are consumers spending? And how much consumers are spending determines how much cash is being circulated, which also affects the supply and demand as well. So even though there's no way of knowing 100% where a currency pair will go because of some new fundamental data, so what we're dealing with is we need to focus on the fundamental data that's available. And again, when we open our trading platforms, we should have an option that allows us to read key news stories. Or if not, then there's the internet, and there's many websites that deliver the news. So there's news everywhere, put it to you that way. And also, since most fundamental data are reported only as a single currency, fundamental data for other currency in the pair would also be needed and would then have to be compared to get an accurate picture. So the news that we get generally affects just one currency. However, if we want information on both currency pairs, we have to check the information that affects both currency pairs, such as, for example, if we wanted to trade on the Australian dollar US dollar pair, obviously we want to examine news reports from both the United States and Australia Also, we want to compare economic data released in the American and Australian media. And that goes for any other pair that we're investing in. Okay, so let's go back to technical analysis for a moment. Technical analysis is important, and the reason why I spend a great deal of time talking about technical analysis and only such little time talking about fundamental and sentiment analysis, it's this. By studying technical analysis, we know how to understand the market and how it works. And with studying technical analysis, we can learn how to read charts and we can learn how to use tools. However, technical analysis works the best when people are trading short term. However, when we're trading long term, it's best to use a lot of fundamental analysis. But really, we should use both. And to keep in mind about technical analysis is it fails when significant fundamental data releases. So going back to the previous videos, remember we talked about fake outs, breakouts, false breakouts. Those are all examples of fundamental data being released during those trading sessions that drive the market completely out of whack. So the objective of this video is for you to understand why we have these false breakouts and these fake outs. It's because of fundamental analysis and also some sentiment analysis that took place during that trading session, meaning the way consumers and investors felt during that trading session that created the volumes to open or close at crazy numbers. Okay, so let's talk about interest rates for a moment. Interest rates are very important when we're doing fundamental analysis. Interest rates are very important in determining how valuable a currency is. So let's take some time to study interest rates and how they work. Now, interest rates control the Forex market and is probably the biggest factor in determining the perceived value of a currency, which means many countries or many economies, they run a central bank, and that central bank is in charge of monitoring the currency and the value of that currency. So it's the responsibility of that central bank to set the interest rate. And it's not good to have the interest rates fluctuating too much because that drives the economy out of whack. So any significant change in that interest rate, we want to pay attention to it because that can signal many changes in the economy and can lead to changes in the value of currencies and what happens with the currency pairs. So also, inflation is a steady increase in the prices of goods and services. So we also want to pay attention to inflation rates as well. So many factors that we have to consider when we get our information from central banks. So obviously, when the inflation increases, the value of the currency decreases. So there's really not much more to say about that in regards to what inflation is. So we need to learn how to analyze interest rates. We also need to learn how to analyze inflation rates when we're doing fundamental analysis. Okay, so here I've made a list of countries and the names of their central banks. So when we are seeking information about the central banks of these countries, we know what their names are. Okay, so moving on to this chart right here. So we need to know what happens when a bank raises or lowers their interest rates. Okay, so when the central bank raises their interest rates, two things happen. Inflation rate decreases and economic growth lowers. However, when interest rates cut, it means the inflation raises. However, that produces stronger economies. So there's advantages and disadvantages to having high or low interest rates. And central banks, they raise and lower their interest rates for different reasons. Okay, so let's go over more information on interest rates. So interest rates, as we know by now, they change as often as markets. And it's also important to know that interest rates tend to shift in line with monetary policy, or more specifically, with the end of monetary cycles. So we also want to keep in mind that when we observe the changes in the interest rates, we know that any change in the interest rates, they happen in periods. So pay attention. So if we want to monitor the interest rates of many different banks, keep in mind that any change usually lasts for a certain period of time, and then it might revert back or it might change again. Also, if rates have been going lower and lower over a period of time, it's almost inevitable, that the opposite will happen. So, in the past, as banks lower their interest rates lower and lower and lower, eventually those interest rates will rise, and that creates a big change in the currency pair. So keep that in mind if you are a long-term trader. So while interest rates change with the gradual shift of monetary policy, market sentiment can also change rather suddenly from just a single report. So again, the Forex market is very sensitive to news reports. And sometimes all it takes is one report or one story to completely blow the currency pair out of sync. So pay attention to the news. That's very important. Okay, also let's talk about rate differentials. So when we're talking about trading different currency pairs from different countries also have different interest rates. So we want to compare the interest rates of the bid currency and the quote currency. Okay, so many Forex traders use a technique of comparing one currency's interest rate to another. And the difference between the two interest rates, known as the interest rate difference, is a key value to watch. So when we're looking at the interest rate of the European Central Bank and the interest rate of the Treasury of the United States, we want to compare the difference between the two interest rates, because that can give us a determination as to how to invest in the euro-dollar market. Okay, now an interest rate differential that increases helps to reinforce the higher yielding currency, while a narrowing differential is positive for the lower yielding currency. So we also want to keep that in mind, that as the interest rate differential either widens or gets narrower, that can create a lot of volatility in that market. So we want to pay attention to the interest rates of both the bid and quote and how different they are. Okay, so let's talk about real interest and nominal interest. Now, the nominal interest rate is the rate of interest before adjustments for inflation. So again, interest rates and inflation. So we want to monitor the relationship between the two. So, real interest rate. If we take the nominal interest rate minus the expected inflation, that's how we get the real interest rate. So also nominal interest rate, it's usually the stated or base rate that you see. So for example, if we're talking about the yields on a bond, that can also affect the interest rate as well, and also can have a profound impact as we're trading in certain currency pairs. And also, if you have a bond that carried a nominal interest rate of 6%, but the inflation was an annual rate of 5%, then the true yield will be 1%. So again, what we're dealing with here is real interest rate, which is equal to that of the nominal interest rate minus the expected inflation. So again, interest rates are a key part in determining which position the market will travel in when we're looking at each currency pairs. Okay, so now let's talk about monetary policy. It works like this. Central banks use monetary policy mainly to control interest rates that are tied to the cost of money, the rise of inflation, the money supply, and also reserve requirements over banks, discount windows leading to commercial banks. So as we can see, many central banks, they use monetary policies to keep their economies stable. So here are the different types of monetary policies. We have contradictory or restrictive money policies. We also have expansionary monetary policies. Also, we have accommodative and neutral. So again, monetary policies and studying monetary policies can also give us an idea as to what will happen with a certain currency in the future. Okay, so a little bit more on monetary policy. Central banks usually have an inflation target in mind. So by setting the inflation target, it keeps the economy stable because you don't want the inflation to change so much, because that can also mean when the economy is in recession, it's very difficult to grab control of it and bring it back into prosperity. So central banks, they like stability. Again, stable economy, easier to control. Economies like stability. Knowing that inflation targets exist will help a trader to understand why a central bank does what it does. So again, the whole purpose of a monetary policy is to keep the economy stable and to keep the currency stable, the value of the currency stable. So policy cycles. Let's talk policy cycles. They're made in small incremental adjustments, meaning if the interest rate must change, it must change as subtle as possible, meaning 0.25% or 0.5%, or they try not to change it more than 1% at a time, because anything more than 1%, it destabilizes the economy, and we don't want that. So interest rate hikes can be like stepping on the accelerator, while interest rate cuts can be like hitting on the brakes. So again, some countries, they want to raise the interest rates in order to increase the economic output to get consumers to spend more money. However, if the economy is moving too far, too fast, and there are people in that country that are not able to enjoy the economic success, well, maybe we need to slow things down to give everyone else a chance to catch up with those that are enjoying economic prosperity. So lowering interest rates, that's sometimes necessary as well. So also keep that in mind when we listen to either we read the news reports or listen to the news reports about how people feel about the economy, because the people's feelings is important as well. Okay, now let's talk more about the central bank and how that works. So it's important to pay attention to what the chairman of the central bank says, or whatever the country calls the head of the central bank. So speeches. Now, every so often, the head of the central bank will make speeches about plans for the future, and also the speech can give us an outlook and also give us an idea as to how the government feels and how the central bank feels, and also how investors feel about the economy. So with fundamental analysis, we're getting some sentiment analysis as well mixed in there. So speeches, they can include anything from changes to the changes to the interest rates or changes to inflation rates or economic strategies. Speeches can be about anything, but remember this: anything that's said in the speech is important, and anything that is said in the speech can have a profound effect in the Forex market. So pay attention to everything that is said by the chairman of the central banks. Now, currency analysts and traders alike take the news and try to dissect the overall tone and language of the announcement. So again, every word that is said in the speech, many investors and also many researchers will analyze what is being said and how it's being said, because that can also determine how people feel and how investors must react to how people feel. So, and also, it's getting easier to foresee how a monetary policy will develop over time, because with the age of the internet, we have more access to different news sources around the world. And there's always a possibility that central banks will change their outlook in greater or lesser magnitude than expected. So sometimes the news can be better than expected, sometimes the news can be as expected, or it can be worse than expected. Okay. Also, we're going to hear these terms frequently: hawks and doves. So, central bankers, they're described as hawkish when they are in support of raising of interest rates to fight inflation, even to the detriment of economic growth and employment. So when we're dealing with banks that are hawkish, that's what they mean. And central bankers that are dovish, on the other hand, they generally favor economic growth and employment over tightening interest rates. So what we're dealing with is, just like we were talking about the bear and bull market, now we're talking about hawkish banks and dovish banks. So I just wanted to throw that out there so you understand what's happening when people are mentioning hawks and doves. So again, a hawkish central bank means they want to raise the interest rates. A dovish central bank means they want to lower interest rates. Okay, so now let's talk about economic growth and outlook. So when consumers perceive a strong economy, they feel happy and safe, and they spend money. Well, that's self-explanatory, because happy people tend to spend more money. That's an easier one to figure out. So studying consumer price index and also consumer spending can give us some good information there. And also, companies with money spend money. So again, companies that are doing successful and they're selling many products, they will take that surplus profit and invest it, which will increase the surplus in their profit as well. So also, weak economies, they're usually accompanied by consumers who aren't spending. So again, if the economy is in a recession, that means many people might not want to spend their money, because maybe they've either lost their jobs or they're afraid that they will lose their jobs soon. So we also want to pay attention to those numbers as well. Okay, let's talk about capital gains. So here's what we need to know about capital gains. They measure the amount of money flowing in and out of the country or economy because of capital investment, purchasing, and selling. So again, we're dealing with the comparison of imports and exports and how much volume is involved there. That can also affect the Forex market as well. And also, when a country has positive capital flow balance, foreign investments coming into the country are greater than investments heading out of the country. A negative capital flow balance is the direct opposite. So again, what we're dealing with is the difference between exports and imports, and the difference between local capital flowing out of the country and foreign capital coming in. So that, when we pay attention to those numbers, that can determine the direction in which the value of the currency pair will head in. So again, there's many factors that we must pay attention to when we're dealing with fundamental analysis. Now, let's talk about trade flows and balance. If there are more exports and less imports, then we have a trade surplus. Trade surplus means we have a positive trade balance. If the imports are more than the exports, then we have a trade deficit, which creates a negative trade balance. So now let's talk about how news and market data affects fundamental analysis. So price moves because of economic reports. A new new central bank chairperson and interest rate changes. So any changes to the central bank, maybe the interest rates move up or down, or maybe the leader of the bank has been replaced. So any changes to the central bank of any currency pair, we want to pay attention to that as well. Also, news moves fundamentals and fundamentals move currency pairs. So again, technical analysis can help us read and understand the charts. However, to understand what's happening behind the technical analysis, that's why we need fundamental analysis as well. Now, it's your goal to make successful trades, and that becomes a lot easier when you know why prices move the way it is. So again, technical analysis can tell us what's happening. Fundamental analysis can tell us why it's happening. So remember, even though we want to use technical and fundamental analysis, we need to know the difference between the two. Okay, so getting market information. How do we get all this information? Well, as I explained before, you do have the option on your trading platform which gives you all the important news stories and also information on which numbers to expect as they are being released. So for example, if you want to know about the Tokyo machine orders, you'll get that information as well. It even tells you the dates in which you'll receive it and experts predicting whether or not the number of Tokyo machine orders will go up or down. So you should have that on your trading platform, but if you don't, there are many places where you can get that information. So that's an example of real-time feeds. Also, economic calendars. You should have that on your trading platform, but there are other places where you can get that information. Market information tips. Again, should be on your trading platform, but for advice on the market, well, you can get that from any financial website. There's always financial analysis that can give you their opinion on the market, so you can follow them as well. Okay, so let's talk about market reaction. It works like this. So there are three ways to analyze a market reaction. There's as expected, meaning the predictions are correct. Better than expected, meaning the information that was expected is better. And then worse than expected, meaning the prediction that was made before and then after, well, the information was worse. So that can also give us some information as to where the market will head in the future. For example, let's look at this chart right here. So we're talking about non-farm payrolls. Now, as we can see, we have three columns. We have the actual, meaning what happened after the numbers were released. Also, we had the forecast, and then we had the previous. So as we can see, in January, the number of new jobs created was 50,000 less. However, experts predicted that there will be 30,000 less jobs created, and the previous, well, was 80,000% less. So we can say that in January, the economic output from the U.S. was worse than expected. However, in February, it was predicted that there will be 35,000 less jobs created. However, it turns out that there were 12,000 less jobs created. So that news was better than expected. So that could have caused an increase in the value of the US dollar based on that information. However, more fundamental analysis would have pushed the value back down to where it should be. So, again, here's what we've learned. We've learned that technical analysis is important, but it can fail if fundamental analysis goes against what technical analysis tells us. So, again, we can't always rely on one way to read the market. We also have to rely on all three ways: technical, fundamental, and sentiment analysis. So again, technical analysis tells us what is happening. Fundamental analysis tells us why it's happening. So again, let's combine everything. Let's combine everything we've learned from technical analysis, and let's combine all of the news reports. Let's combine all of the economic data that is released, all of the non-farm payrolls, all of the new homes being built in the United States and Australia, the unemployment rates in the UK and Europe, the interest rates from the Bank of Japan, the interest rates from the banks of Australia, New Zealand, and every other reserve banks. So when we combine technical and fundamental analysis, we can have a very, very strong advantage when we invest in the Forex market. And the chances of making great profits when we invest will increase significantly. Not 100%, because we do lose money on some investments, as I will explain in later videos, but we can use this information to reduce our risk and increase the size of our profits. Thank you for watching this video, and good trading.